Tom Lee just came on CNBC's Squawk Box and gave a blunt warning about what he thinks 2026 is going to feel like. His words were, 2026 will be joy, depression, then a rally. In this video, I'm going to play you the clip first, then I will break down what Tom really meant, and how I think investors should interpret it for the months ahead. After that, I will share my pick and full analysis of the best growth stock you can buy right now with $1,000. Before we dive in, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Now let us hear what Tom Lee has to say.
We're going to hear from Tom Lee now, Fundstrat, Head of Research and Fundstrat Capital Chief Investment Officer. Tom, welcome. Thanks for being on set.
See you, sir.
One thing,
to see you.
It is important the way the market gets out of the gate. That we can say. It doesn't determine everything, but when you start strong at the beginning of the year, it's usually good. This is the Wall Street Journal. This is like the worst headline you could possibly have. Wall Street experts expect rally to keep going.
Yeah.
Just don't, even if you think it, don't print it. Don't say that. I mean, that to me just makes me think that it could be a down year.
Yeah, but it wasn't splashed on the top of the page. It's only a little bit a corner.
And you're right in there because you think 7,700 by the end of 2026 with a 15 to 20% correction at some point in the second half of the year.
Yeah, like compressed in 1 year will be joy, depression, and rally, right? I think just like last year, in 2025, we had a terrible start. People got very gloomy. Then we had a nice rally to finish the year.
You mean April was the peak
April was the low.
The Liberation Day. Yeah.
So I think because, the market will test the new Fed, that probably is the reason we have some fear this year. But there's a lot of things to be optimistic about. The tariffs are anniversarying. The Fed is cutting. And, the ISM could finally turn back above 50, and that's good news. And we are pretty optimistic about some groups that have lagged, like energy is one of our top sector picks this year.
With the Mag 7.
And the Mag 7 should still keep producing good earnings growth. And then the financials and small caps. So it's like a lot of things that could go right in the market.
The 7,700, so do we get a 10% gain in earnings and the multiple stays where it is? Is that your thesis, basically?
I think earnings will do even better.
And the multiple comes down.
Yeah, so it's because other sectors are re-rating, but the Mag 7 might just track their earnings growth, so that'll pull the overall PE down. Once again, not only are you telling us we're going to be up, you're even telling us when it's going to go down, when it's going to go up. You got a number, 7,700. You're back on the horse of predicting Bitcoin, even though it didn't work out last year. It did not.
Your numbers were not hit, and it's like, no, I would not say that you're a terrible financial advisor based on trying to predict Bitcoin. I don't know who could do that. So I'm not going to hold your feet to the fire. But as I said, you're getting right back on the horse. 250? 250,000?
Yeah. You can bleep me out, too, if I just say the number.
Yeah, that'd be good for you. We don't care. I'm trying to protect you. 250.
Yeah.
250,000, not $250. Which some people still have as a forecast.
So, in 2026, if Bitcoin gets to 200 or 250,000, it would be breaking the 4-year cycle. So that's sort of part of our view is that this, if you follow the 4-year cycle, Bitcoin should be down this year. But I think that there's tailwinds that are building. And part of it is we kind of reset leverage on October 10th with that big shock.
Right.
And now I think there is still institutional adoption taking place, and Wall Street is still building a lot of products on the blockchain. And then we have U.S. government support. So I think these are tailwinds that help Bitcoin recover this year.
And even though people have pointed out the divergence from gold and silver, you think with gold and silver doing well, eventually Bitcoin benefits from that trade?
Yeah, it does look like gold rallies typically lead Bitcoin rallies. So I think it's been healthy for gold to rally. Part of it's, dollar debasement, and now with monetary easing, those are things that are supportive of crypto to follow. And as you know, crypto adoption rates are still quite low. So crypto has sort of an exponential growth opportunity because the adoption is increasing.
You even think that an improving ISM is bullish for crypto?
It is. For whatever hard to explain reason, we found that copper to gold price ratio, when that rises, that coincides with Bitcoin rallying. And we also found that the ISM, as it moves from below 50 to its peak, has coincided with Bitcoin entering its sort of rally stage. So
you don't know why, you just have noticed that it happens.
Yeah.
Do you have a forecast for oil? I mean, I think the oil movement last year confounded a lot of people. Now you've got Venezuela on top of this. How do you figure that out?
Yeah, it has been sort of surprising how badly oil's done. I know our technician, Mark Newton, thinks oil could actually see something like 40 early this year, but that won't necessarily hurt the stocks because I think the equities have been lagging for so long. I mean, if you look at
the big majors, you mean?
Yeah, so the majors should do well. So I think energy stocks are going to start discounting higher oil even as oil gets to 40.
The move that we saw, the broadening of the market into even small caps and I don't know, Russell, does that continue? Is that necessary? I think it seems healthy if that were to happen.
Yeah, I think it's healthy and it's important. The small caps made an all-time high last year, which is great because that's been a long time coming. And lower interest rates helps them, monetary easing. Earnings growth is starting to look better. And if we have mergers, I think all of these are tailwinds for small caps. And of course, small caps should have been tracking EM stocks. EM did really well last year. Small caps are just finally catching up.
They kicked it off with that old Wall Street saying about how the first day sets the tone for the week sets the tone for the month, and the month sets the tone for the year. And even the host basically admitted that maybe none of that always holds the way it used to. Because markets have changed, information moves faster, and narratives can flip in a single session. But the point was clear. Everybody is watching the start of 2026 because sentiment is fragile after a big prior year, and because positioning tends to reset in January. Then the conversation immediately turned into a psychology check because the host brought up what he called the worst possible headline to see at the beginning of the year. When the media starts pushing a "experts expect the rally to keep going" vibe, it triggers that contrarian fear in a lot of experienced traders. The logic is simple. If everybody already believes the market is going higher, who is left to buy? That does not mean the market must fall, but it does mean optimism can become its own risk factor when it gets too loud, too early. And Tom's response was basically, yes, the market can absolutely have a great year, but it will not be a straight line. He anchored his view with a very specific forecast. He thinks the S&P 500 can get to 7,700 by the end of 2026, but he also expects a 15 to 20% correction somewhere in the second half of the year. That is important because it tells you how he is framing this year emotionally. In his mind, 2026 is not a calm year, it is compressed. Joy, depression, rally, all in one calendar year. He referenced 2025 as the template. He reminded everyone that last year had a terrible start, people got gloomy, and then the market managed to rally to finish the year strong. They even pointed to April as the low, and they called it Liberation Day in the conversation. The label is not the point is the pattern, early pain, late recovery. Tom is basically saying, do not let a drawdown convince you the entire year is broken, because the market has a habit of shaking people out before it resumes a trend. Now here is where the macro part matters. Tom thinks the market is going to test the new Fed. That phrase is doing a lot of work. It implies a regime shift, or at least a credibility test, where the market challenges the central bank's reaction function. In other words, investors will push, the Fed will respond, and the market will keep probing until it figures out the boundary. That alone is enough to create volatility, especially in the second half of a year when growth and inflation narratives tend to become more contested. But Tom also laid out why he thinks there are real reasons to be optimistic. He mentioned tariffs being an anniversary, which I interpret as the market having already digested a lot of the tariff story as known risk rather than fresh shock. He also said the Fed is cutting. Whether you love or hate rate cuts, equity markets generally like the direction of easier policy, especially if it is happening while growth is still standing. And then he pointed to the ISM potentially turning back above 50. That is a big deal for cycle watchers because 50 is the dividing line between contraction and expansion in that kind of survey data. If ISM pushes above 50 and holds, it supports the idea that the economy is not rolling over and it can justify broader participation beyond just the mega caps. That brings us to his sector view, which was actually one of the most useful parts of the interview. Tom is not acting like the whole year depends on the Magnificent Seven. He specifically said energy is one of their top sector picks this year, and he paired that with the idea that the Mag 7 can still deliver strong earnings growth. Then he also called out financials and small caps. That is basically him describing broadening. Mega caps can keep working, but leadership can expand into areas that have lagged. And when you hear broadening, you should immediately translate that into market health. It does not mean everything goes up at once, but it means the rally is less fragile. When only a handful of names are carrying the index, the market becomes vulnerable to any disappointment in those names. When more sectors start participating, the market can absorb shocks better because leadership is shared. They pushed him on the math behind 7,700, and the host basically asked the obvious question, is this just a story where earnings rise 10% and the valuation multiple stays where it is? Tom's answer was telling. He thinks earnings can do even better, but he also thinks the overall multiple could come down. That sounds contradictory until you understand the mechanism he is suggesting. What Tom is really saying is this: the index can still go higher, even if the headline valuation looks less stretched, because the composition of the rally changes. If other sectors re-rate upward, while the Mag 7 simply tracks their earnings growth without expanding their multiples, then the index can climb while the overall price to earnings multiple drifts down. The market becomes less dependent on a few expensive names and more supported by a wider base of improving fundamentals. That is the kind of scenario that usually makes rallies more durable, even though you still get violent pullbacks along the way. Then the interview shifted into Bitcoin, and the tone got playful because the host teased him about being willing to put a number on it again. Tom acknowledged he missed it last year, and honestly, that humility matters because Bitcoin is notoriously hard to forecast. But he still put his range out there. He is talking about Bitcoin potentially reaching 200,000 to 250,000 in 2026. What is interesting is the framework he used. He talked about the 4-year cycle and said that hitting those levels would break the expected pattern, because by the cycle logic, Bitcoin should be down this year. So he is not leaning on cycle superstition. He is leaning on what he believes are new tailwinds that can overwhelm the typical pattern. He cited a reset in leverage that happened around October 10th, with a big shock. The core idea is that a big flush can clear out weak hands and excessive leverage, and that can create a healthier base for a future rally. Then he pointed to institutional adoption continuing, and he said Wall Street is still building products on the blockchain. That is another key point. Regardless of how you feel about crypto philosophically, more financial product infrastructure tends to reduce friction for adoption, and it tends to expand the addressable investor base. And he also mentioned U.S. government support as part of the tailwind mix. Whether that plays out as regulation clarity, market structure, or a more supportive posture, the point is that policy can shift crypto from outsider asset toward institutional asset, and that matters for flows. They also talked about the divergence between Bitcoin and gold and silver, and Tom's view was basically that gold's strength is not bad for Bitcoin. He argued that gold rallies often lead Bitcoin rallies. The connecting tissue here is the hard asset narrative. When investors are worried about currency debasement, or when monetary policy is easing, gold can catch that bid first. Then, Bitcoin can follow, if investors decide they want the more volatile, higher beta expression of the same theme. And Tom made another point that I think people underestimate: crypto adoption rates are still low. If you believe that adoption continues to rise, then you get something close to an exponential growth setup, at least in the narrative sense. Low penetration plus rising accessibility plus improving infrastructure can produce a big move, even if the path is ugly and full of drawdowns. Then came the quirky correlation talk, and I actually appreciate when analysts admit what they do not fully understand. Tom said they found that when the copper to gold price ratio rises, it coincides with Bitcoin rallying. He also said ISM moving from below 50 toward its peak has coincided with Bitcoin entering a rally stage. When you translate that into plain English, he is basically saying Bitcoin tends to do better when the macro cycle is improving, when growth expectations rise, and when risk appetite returns. Copper is often treated as a growth-sensitive commodity. Gold is often treated as a defensive store of value, so the ratio can act like a risk-on signal. Is it perfect? No. But it gives you a framework. Bitcoin may not be purely digital gold in practice. It can trade like a liquidity and risk appetite asset, especially around inflection points in growth. After that, they switch to oil and energy. And this is where Tom's take becomes very contrarian, because oil has disappointed a lot of people recently. He said it has been surprising how badly oil has done, and he referenced their technician, Mark Newton, suggesting oil could even see 40 early this year. That is a dramatic statement, because $40 oil usually makes people think energy pain. But Tom's punchline was the opposite. He said even if oil drops toward 40, it does not necessarily hurt energy stocks, because energy equities have been lagging for so long. His argument is that markets discount the future, not the spot price. So energy stocks can begin pricing in higher future oil prices, even while the current oil price is weak. That is a classic equity versus commodity disconnect that happens when the market believes the bottoming process is underway. They clarified they were talking about the big majors, and his view was that the majors should do well. That fits the idea that large integrated energy companies can manage through commodity volatility better than smaller, more leveraged producers. Again, the key concept is discounting. If the market believes oil weakness is temporary and the cycle is turning later, energy equities can move early, and then they closed by talking about the broadening into small caps. Tom was very clear that he thinks broadening is healthy and important. He noted that small caps made an all-time high last year, and he framed that as something that was a long time coming. The logic is straightforward. Lower interest rates help small caps because small companies are typically more rate sensitive. They often have more floating rate exposure, and refinancing conditions matter more to them. Monetary easing helps. Improving earnings growth helps. And then he started to bring up mergers and acquisitions as another potential tailwind, but the transcript cuts off right as he is about to finish that thought. So let me be precise about what we can and cannot take from this transcript. We do not have the rest of his sentence on M&A, so I'm not going to pretend we do. But based on what he already said, the setup is obvious. If rates are coming down, credit conditions ease, and corporate confidence improves, M&A activity can pick up. That can benefit small caps, it can benefit financials, and it can create additional catalysts inside the market beyond just Magnificent 7 earnings beat again. If I had to summarize my reaction to Tom Lee's message, it is this. He is bullish on the destination, but he is not sugarcoating the journey. 7,700 on the S&P by the end of 2026 is the headline, but the more important detail is the expected 15 to 20% correction in the second half. That tells you he expects volatility, a sentiment wipeout at some point, and then a recovery. He is also signaling that the market can become healthier if leadership broadens into energy, financials, and small caps, while the megacaps continue to deliver on earnings without needing infinite multiple expansion. And on the crypto side, he is basically saying the normal cycle expectations might not matter as much this year because the structural tailwinds are stronger than before. Leverage has been reset, institutions are still moving in, and policy and product infrastructure are evolving. Whether you agree or not, that is the thesis he is putting on the table. The way I would approach this as an investor watching that interview is not to take the targets as guarantees, but to take the frameworks seriously. Watch for whether the ISM truly recovers above 50. Watch whether breadth improves, meaning more stocks participate, rather than just a few giants. Watch whether small caps continue to hold their breakout behavior in a falling rate environment. Watch whether energy equities start acting stronger than oil itself. And if you're following Bitcoin, watch whether it starts responding the way Tom described, with improving growth signals and risk-on conditions, and whether it begins to track gold's strength with a lag the way he suggested. That is the real value in what Tom said. Not the exact number on a calendar date, but the map of what needs to go right, what might go wrong mid-year, and how the leadership could rotate if this bull case is going to work. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the best growth stock to buy now. The stock I believe is the ultimate growth opportunity for your $1,000 right now, MercadoLibre. Ticker MELI. This company is a powerhouse, and its story is just getting started. Based in Latin America, MercadoLibre is more than the Amazon of Latin America. It's Amazon, PayPal, and Shopify rolled into one. Imagine a single platform where you can shop, pay, and even run your own business, all seamlessly integrated. It operates the largest online commerce and payments ecosystem in Latin America, dominating markets like Brazil, Mexico, and Argentina. These are massive economies with millions of people coming online for the first time. For millions, MercadoLibre is the go-to for both shopping and digital payments. Whether you're buying groceries, electronics, or sending money to family, Meli is at the center of daily life. It's become essential infrastructure for digital commerce and finance across the continent. In many ways, it's helping to bridge the gap for people who never had access to traditional banks or retail. The synergy between its e-commerce and fintech businesses creates incredible customer loyalty and high barriers to entry. Competitors struggle to match 𝗟𝗟's scale, trust, and innovation. This isn't a distant future, it's happening now. MercadoLibre is already profitable and growing at a rapid pace, with revenues and users climbing quarter after quarter. The digital transformation of Latin America is accelerating, and 𝗟𝗟 is at the center. As more people gain internet access and smartphones, 𝗟𝗟's reach only expands. Investing in 𝗟𝗟 is a bet on the region's economic rise, with a proven leader at the helm. The management team has navigated economic ups and downs, always coming out stronger. This is your chance to own a piece of Latin America's digital future. With MercadoLibre, you're not just investing in a company, you're investing in the growth of an entire continent. Let's break down the two engines driving MercadoLibre's explosive growth, e-commerce and fintech. These aren't just business segments, they're the foundation of a digital revolution sweeping across Latin America, transforming how millions of people shop, pay, and manage their money. E-commerce penetration in Latin America is just over 15%, far behind the US and China, where online shopping is already a way of life. This means that the region is still in the early innings of digital adoption, with huge potential for more people to come online and embrace e-commerce. That's a massive runway for growth. As internet access and smartphone usage rise, more consumers are discovering the convenience of shopping from home, opening up new markets and opportunities every day. As the clear leader, 𝗟𝗟 is set to capture a huge chunk of this expansion. Its vast logistics network and trusted brand give it a head start over competitors, making it the go-to platform for buyers and sellers alike. The second engine is Mercado Pago, its fintech arm. What began as a simple payment tool has evolved into the region's leading digital wallet, now powering everything from online checkouts to in-person transactions at local shops. Mercado Pago is bringing millions into the formal financial system for the very first time. For many, it's their first experience with digital banking, savings, and even credit, unlocking new possibilities for families and small businesses. These two engines are deeply intertwined, creating a powerful flywheel effect. Each side strengthens the other. As more people shop online, more use Mercado Pago, and, as more use the wallet, e-commerce grows even faster. Customers come for shopping, discover the wallet, and soon start using it for everything, from paying bills and sending money to investing and managing their finances, all within one ecosystem. This seamless experience increases engagement and loyalty, fueling a virtuous cycle of growth. The more services MercadoLibre offers, the more customers rely on it for their daily needs. By providing accessible, digital financial tools, MercadoLibre empowers a new generation of consumers and entrepreneurs. It's not just about shopping, it's about enabling people to build businesses, access credit, and participate in the digital economy. They offer credit to small merchants, asset management to everyday people, and even insurance products, unlocking a multi-trillion-dollar market that was previously out of reach for many. By solving real needs and building trust, MercadoLibre is creating loyal customers and opening up massive business opportunities, reshaping the future of commerce and finance in Latin America. Let's look at the numbers. In Brazil, MercadoLibre lowered its free shipping threshold, triggering a surge in new customers, up 29% in a single quarter. The result? The highest ever number of new customers and a 42% jump in items sold. The platform's inventory quadrupled year over year. Company-wide revenue surged 49% on a currency-neutral basis. Gross merchandise volume grew 39%. The fintech side is growing even faster. Total payment volume up 54%, and assets under management up 89%. This isn't just growth, it's accelerating growth across every key metric, and they're doing it profitably, operating income up 30%, with a healthy margin of 9.8%. Right now, the company carries a market cap of $100 billion, and it trades at a price-to-earnings ratio of 48.08, which tells you the market is willing to pay a premium for the growth and profitability profile it's delivering. Earnings per share sit at $41.05, and in 2024, the business generated $20.77 billion in revenue, translating that scale into real bottom-line performance with net income of $1.91 billion. Put it all together, and you're looking at a company that's not just growing, but also proving it can convert that growth into meaningful earnings, which is exactly what long-term investors want to see. MercadoLibre is delivering explosive top-line growth and strong profitability, the holy grail for investors. This is what hypergrowth looks like in real time. The numbers speak for themselves. Seeing these numbers is one thing, finding the next MercadoLibre is another. It takes a system, a framework for analyzing businesses, spotting trends, and identifying companies with real competitive advantages. That's what we teach in our exclusive investing masterclass. We show you how to screen for high-growth stocks, analyze financial health, and spot the trends that drive multi-bagger returns. Learn about moats, flywheels, and total addressable markets, not as theory, but as practical tools. Imagine building a portfolio of high-growth companies with confidence. Click the link in the description to learn more and enroll. Now, let's get back to why MercadoLibre's current price is such a compelling entry point. MercadoLibre has two powerful growth engines, accelerating metrics and strong profitability. You'd expect a sky-high valuation, but Meli trades at a price-to-earnings ratio of about 71. For a company growing revenue nearly 50% year over year, that's attractive. The market isn't fully pricing in Meli's long-term growth trajectory. This is our window of opportunity. As Meli scales, its high-margin fintech business will expand profit margins even further. Earnings could grow even faster than revenue, making today's valuation look like a bargain in hindsight. Meli has a strong balance sheet and generates significant cash flow, funding its own growth. You get the upside of a hyper-growth company with the stability of a mature enterprise. It's the best of both worlds. This is a rare opportunity for savvy investors. We've covered a lot on MercadoLibre, but a single analysis is just a snapshot. The best investors stay ahead with real-time insights and a strong community. Join our exclusive group for access to real-time stock tips, deep company teardowns, and up-to-the-minute market commentary. We don't just tell you what to buy, we explain the why, helping you build conviction. You'll be part of a community of like-minded investors, sharing ideas and learning together. Don't let another opportunity pass you by. Click the link to join us. We provide the tools, research, and support to help you build a winning portfolio. Start investing with confidence. Join us today. We've laid out the case for MercadoLibre, a dominant leader in e-commerce and fintech, with a massive runway for growth. With $1,000, you can buy into this incredible story and participate in Latin America's digital transformation. This is a rare combination of quality, growth, and opportunity. Now, I want to hear from you. When you evaluate emerging market investments, what's the most important factor you consider to balance growth and risk? Share your thoughts in the comments. If you found this analysis helpful, hit like, share with a friend, and subscribe for more deep dives. The goal isn't just to make money, it's to make informed decisions that build lasting wealth. Stay disciplined, keep hunting for opportunities, and remember, the right company, right market, right time can change everything. I'll see you in the comments and back here for the next